Listen up because we're diving into the wild world of central bank rates and their impact on Forex and metals. These rates, folks, they're the puppet masters of the global economy. They can send currencies soaring or crashing down like a house of cards. And when it comes to gold, forget about it. Higher rates make this shiny metal look like yesterday's news, while lower rates send it through the roof. We're talking serious volatility here, folks, and you need to be ready to ride the wave. Buckle up because we're about to break it all down Mad Money style. All right, people, let's talk currency valuation. It's all about supply and demand, just like any other market. When a country's central bank raises interest rates, it's like a giant magnet for foreign investment. Think about it. Higher returns, who wouldn't want a piece of that action? This influx of capital drives up demand for the currency, pushing its value higher. It's simple economics, folks. But here's the flip side. When rates go down, it's like someone just popped a leak in that currency's balloon. Investors head for the exits, taking their money and running to greener pastures with better returns. This exodus weakens the currency, making it less valuable on the global stage. It's a constant tug of war, my friends, and central bank rates are the referees calling the shots. Remember, this isn't just some academic theory, it's real money at stake. Businesses, investors, even everyday folks like you and me feel the impact of these currency swings. So whether you're planning a trip abroad or just trying to understand the global financial landscape, you better pay attention to those central bank announcements. They can make or break your day, believe me. But don't worry, we'll be here to guide you through the madness. Stick with me and we'll navigate this market together. Now, let's talk about the currency battlefield interest rate differentials. This is where things get really interesting, folks. Forex traders, those sharp-minded individuals who live and breathe currency fluctuations, are obsessed with these differentials. They're constantly comparing interest rates between countries, looking for opportunities to profit from the slightest discrepancies. Think of it like a game of high-stakes poker, where each currency is a player vying for dominance. The currency with the higher interest rate has the upper hand, attracting more investors and gaining strength. It's like a magnet pulling in all the chips, leaving the weaker currency with a dwindling stack. These traders are like hawks, constantly circling, looking for the next big move. They're buying and selling currencies at lightning speed, exploiting these differentials to make a killing. It's a fast-paced, high-pressure environment, and only the savviest players survive. But here's the thing. Even if you're not a seasoned Forex trader, understanding interest rate differentials is crucial. It gives you a glimpse into the forces shaping currency valuations, helping you make informed decisions about your own investments and financial strategies. So, keep your eye on those differentials, folks. They're the key to unlocking the secrets of the currency market. Hold on tight, folks, because we're diving into the world of market speculation, where expectations reign supreme. When it comes to central bank rates, it's not just about the actual changes, it's about what the market thinks is going to happen. Remember, these traders are a skittish bunch, always anticipating the next move. Even a whisper of a potential rate hike can send currencies soaring, while rumors of a cut can trigger a sell-off. It's a game of anticipation, with traders trying to outsmart each other and predict the future. They analyze every piece of economic data, every statement from central bankers, looking for clues about the direction of rates. This constant speculation creates volatility, folks, with currencies swinging back and forth like a pendulum on steroids. It's a wild ride, and you better be prepared for some twists and turns. But here's the key. Understanding how market sentiment and expectations drive these fluctuations can give you a leg up. By keeping your finger on the pulse of the market, you can anticipate these swings and position yourself to profit. Remember, knowledge is power, especially in this volatile world of Forex trading. So stay informed, stay vigilant, and never underestimate the power of market speculation. All right, folks, let's get down to brass tacks and talk about economic indicators. These are the vital signs of a country's economy, the data points that central bankers scrutinize before making their rate decisions. We're talking about GDP growth, inflation, employment figures, the whole 9 yards. Think of it like a doctor checking a patient's pulse, blood pressure, and temperature. These indicators provide a snapshot of the economy's health, revealing its strengths and weaknesses. Central bankers use this data to diagnose any imbalances and prescribe the appropriate monetary policy. Strong economic growth and rising inflation? That's a signal for a rate hike, folks. A sputtering economy and deflationary pressures. Time to cut rates and stimulate growth. It's all about finding the right balance, the sweet spot that keeps the economy humming along. Now, here's where it gets interesting for us investors. By keeping a close eye on these economic indicators, we can anticipate central bank actions and position ourselves accordingly. Remember, those rate decisions can make or break our portfolios, so staying informed is crucial. Whether you're a seasoned trader or just starting out, understanding the language of economic indicators is essential. It's the key to deciphering the central bank's playbook and making informed investment decisions. So, do your homework, folks, and stay ahead of the curve. Now, let's talk about gold, that shiny metal that's been a store of value for centuries. But here's the thing, folks, gold doesn't pay interest. It just sits there gleaming while other assets are generating returns. So, when central banks raise interest rates, holding gold becomes less appealing. Why settle for zero return when you can earn a decent yield elsewhere? This shift in investor sentiment can send gold prices tumbling. Higher rates make other investments more attractive, drawing capital away from precious metals. It's like a game of musical chairs, and gold is often left standing when the music stops. But here's the flip side. When rates fall, gold regains its luster. Suddenly, that zero return doesn't seem so bad, especially when other assets are struggling to generate income. Investors flock back to gold, seeking safety and stability in uncertain times. This surge in demand can send gold prices soaring, making it a shining star in a gloomy market. So what's the takeaway here? Gold is a rate-sensitive asset, folks. Its price fluctuating with the ebb and flow of central bank policy. By understanding this dynamic, we can anticipate these swings and make informed investment decisions. Remember, gold can be a valuable addition to any portfolio, but it's crucial to time your entry and exit based on the prevailing interest rate environment. Okay, folks, let's delve into the psychology of gold, its enduring allure as a safe haven asset. When economic storm clouds gather, when uncertainty grips the markets, investors instinctively seek refuge in gold. It's a primal instinct, a flight to safety that's been ingrained in us for centuries. Remember 2008, the financial crisis that shook the world? Gold prices skyrocketed as investors dumped risky assets and piled into this timeless safe haven. It's a recurring theme throughout history. Whenever fear and uncertainty prevail, gold shines brightly. But here's where central bank rates come into play. Low interest rates, particularly in times of economic distress, amplify gold's safe haven appeal. Think about it. If you're earning next to nothing on your savings, why not hold an asset that's historically preserved wealth during turbulent times? This confluence of factors, economic uncertainty and low interest rates, creates a powerful tailwind for gold prices. Investors flock to its perceived safety, driving up demand and pushing prices higher. It's a classic case of supply and demand, magnified by the emotional undercurrents of fear and uncertainty. So what's the lesson here? Gold's safe haven status is deeply intertwined with central bank policy. When rates are low and economic anxieties run high, gold becomes a beacon of stability, a port in the storm. Understanding this dynamic can help us navigate the market's choppy waters and make informed investment decisions. All right, folks, let's shift gears and talk about industrial metals, the unsung heroes of the global economy. We're talking about copper, aluminum, nickel, the building blocks of our modern world. These metals are essential for construction, manufacturing, infrastructure, you name it. But here's the thing, demand for these metals is highly sensitive to economic activity. When economies are booming, construction projects flourish, factories hum with activity, and demand for industrial metals surges. Higher demand translates into higher prices, folks. It's the law of supply and demand in action. But what happens when central banks slam on the brakes, raising interest rates to cool down an overheating economy? Well, those construction projects might get put on hold, manufacturing activity slows down, and demand for industrial metals takes a hit. Lower demand means lower prices, folks. It's the inevitable consequence of tighter monetary policy. So what's the takeaway for investors? Industrial metals are like economic barometers, their prices reflecting the ebb and flow of global growth. By keeping an eye on central bank actions and their impact on economic activity, we can anticipate these price swings and position ourselves accordingly. Remember, industrial metals are crucial components of the global economic engine, their fortunes intertwined with central bank policy. Understanding this dynamic can give us a valuable edge in the markets, helping us navigate the complexities of this interconnected world. So there you have it, folks, the wild world of central bank rates and their impact on Forex and metals. These rates are the puppet masters, pulling the strings of the global economy. They can send currencies soaring or crashing, make gold gleam or fade, and even dictate the fate of industrial metals. It's a high-stakes game, folks, and you need to be informed to play it right. Keep your eye on those economic indicators, anticipate those market swings, and remember, knowledge is power. Stay informed, stay vigilant, and you'll be well equipped to navigate this exciting and ever-changing market.